Hello, this is Christine Groves of Coldwell Banker Residential in Chicagoland. Here to talk to you today about the difference between short sales and foreclosures, also known as REOs. A lot of people, of course, have heard of these two types of sales of homes, especially in this market the past several years with the changing economy. And I wanted to definitely explain the difference because there is quite a difference. There are definitely advantages, especially when you're looking to purchase a property, possibly get a decent deal. But then there are certainly risks involved, and you have to be knowledgeable of these risks before deciding whether or not this is the type of transaction that is right for you. First of all, short sales. I will say that short sales, there is no two transactions that are ever alike, and that actually goes for foreclosures as well. But with a short sale, you have a couple different parties involved. You have the seller that technically owns and occupies the property. It may or may not be vacant already. And then you have the bank, the lender, that has the lien or the mortgage on the property. And there may be more than one lien on the property if there's a second mortgage or a home equity line of credit or some other lien on the property, such as unpaid taxes, homeowners association fees, mechanics liens, all of that. So basically how that works is the current owner has a qualifying hardship. This can be anywhere from a bankruptcy, job loss, medical issues, a job relocation, divorce, whatever the situation is, to where they need to sell the home because they cannot make the payments or they can no longer reside in the property. But what the home will sell for on the current market will not be enough to pay off the lien on the property or the mortgage to the lenders and anyone that has a lien on the property. So the name short sale does not mean that the transaction will be short, but rather that it will sell for a price that is short of what is owed on the property and anything attached to the property. So how this works is when you have a buyer that is interested in purchasing a home that is pursuant to short sale, they put in an offer. The owner then first has to, just like any other traditional transaction, would have to sign off on the offer. They may negotiate a higher price or not. They just want to get it sold. And then you have an executed purchase contract once it's signed by the seller, but it is pursuant to the bank and lien holder approval or approvals if there's more than one. And that's when the process takes some time. Once you have an offer contract signed by the seller, typically then the buyer will provide earnest payment, conduct their home inspection contingency, and all of that. And so you as a buyer would have to pay for that inspection out of your own pocket, whether the transaction goes through or not. And then in the meantime, all of the documents from the seller go to the bank and the lien holders, basically asking them for their permission to sell it for a certain amount and forgive them for the difference of what is owed on the lien or liens. And so that's why the process can take some time. Short sales can take anywhere from 60 to 90 days, upwards of over a year. It just depends on the bank and their processes and how much the property will sell for short, how many lien holders are involved, because that takes a lot of extra time the more lien holders you have. And so from there, we're asking for the bank's permission. The bank has to do an appraisal or a broker price opinion, a BPO, on the property to see what it's really worth on the market. And if they do decide to release the property and sell it for short, then we need to get their approvals and whatnot. And on the seller side of it, you need to make sure that the seller has a very good short sale attorney who is used to the process, as well as a listing agent who has done this before as well. There are a lot of documents on the seller's end that they have to file to make sure that they have a qualifying hardship. This is bank statements, tax returns, pay stubs, letters, any supporting documents of a financial hardship. And it's the paperwork that can really take some time. When and if you get the approval from the bank, they will either accept the offer that is on the table the way that it is, or they may provide a counter offer for a different amount based on their broker price opinion and appraisal, and they may ask for different terms as well. Obviously, cash buyers are always preferential because they don't have a mortgage loan contingency, but also owner occupants are preferred by these banks, people that will actually move into the property and not just invest and try to flip the property. So if you are able to get the bank's approval, then you just wait and prepare for closing. There are many risks involved in that. At any time the bank can change their mind. They can decline. Even after a counter offer, they can change their mind. There is no guarantees anywhere along the way. There's no guarantees on timelines as well. Sometimes even closings that are scheduled get pushed because it definitely is an intricate process. So as a buyer, you've been waiting on this house, you've spent money on inspections, you've paid your earnest, you're waiting, you're trying to make arrangements to move. And so it's very unpredictable and it can be very risky. I really only suggest this type of sale to a buyer that has optimal flexibility as far as when they need to move, their ability to get a mortgage, and be flexible with the price. If you intend on putting in a lowball offer on a short sale, don't count on getting it for a loan amount. Banks definitely have a very specific amount in mind that they would like to get, which is market value or at least close to it. So there are risks involved with that. So now let's talk about foreclosures, or REOs, which stands for real estate owned, basically owned by the lien holder. A foreclosure is something where they've already taken the property and the title and the deed back from the owner occupant. They've already gone through the court system if you live in a judicial state, like Illinois is a judicial state. So the bank actually has to go through legal proceedings to reclaim the property and go through that sale. If the property has been foreclosed on, typically it'll be vacant. Most banks do not rent out properties during this process. And once a property has been foreclosed on and a lease pendants has been filed and they've gone through the court system and actually gotten the court order to regain the title, it is their decision and when they will put that on the market. It's not automatic that it will be immediately listed once the bank regains control. That's what's called shadow inventory, when the bank has a certain amount of assets and properties on their books that they decide to release onto the market. So with a foreclosure, you're only dealing directly with the bank. And at that point, there's usually just the one lien holder. Again, there are no two foreclosures that are alike, but typically a foreclosure will require a little bit less time than a short sale because there are less parties involved. And you would submit your offer directly to the bank, which is now the owner of the property, and wait for their approval. You will spend money on your home inspection, always do a home inspection, and then go through the standard offer acceptance process and the waiting and all of that. And then typically most of your weight is on your offer itself. Because once you put in that offer, you're waiting for the acceptance. Once you can get acceptance, then you have a more definitive timeline of how long it may take for the bank. And in dealing directly with the bank, a lot less parties involved. They will have attorneys on their end. You definitely want an attorney representing you that has dealt with foreclosures before, and a real estate agent who's also navigated this process before. So hopefully that makes a little bit more sense, gives you some more details about the potential investment advantages, but the many, many risks and unpredictability that can go along with these transactions. Many people have gotten some great homes through this process. These homes are also called distressed homes. They're not always in distressed condition, but 9 times out of 10, they definitely need some work because these have had prior owners that have not had the money to maintain these. And some people who have honestly gotten kicked out of their homes and been foreclosed on and aren't too happy about it and really don't care about the condition that they leave their home in. But it can be a great potential investment for people. And so if you have the flexibility, if you have the patience, I highly suggest, looking at these as well as traditional sales on the market. I certainly can assist anyone in the Chicagoland area either with listing these properties or helping to purchase those properties. I have lots of experience on both ends with short sales and foreclosures. I am SFR, short sale foreclosure resource trained, and would definitely appreciate assisting you with that. I can be contacted on my mobile, which is my direct line at 630-346-3272, or on my website at www.groves, G-R-O-V as in Victor, E-S-realty.com. Here in the Chicagoland area, here to help you with all of your real estate needs. Please contact me at any time, and I hope to hear from you soon. Have a great day.